So today, what are we talking about, or what is the topic of the lesson we are dealing with? Principles, concepts, and conventions of accounting. That is the lesson. Principles, concepts, and conventions of accounting. These are things that get to guide accounting, but what are they? So what are accounting principles? Accounting principles are fundamental concepts that guide the practice of recording and reporting financial transactions. Now they get to ensure consistency, reliability, and comparability of financial statements. This is what the accounting principles are all about. So what are these principles? Examples of these principles. Number one, we have revenue recognition principle. Now this gets to state that revenue should be recognized when it is earned, regardless of when the payment is received. So once you earn the revenue, you should recognize it, no matter when they're going to pay you. You know you worked for it already. Yes, you should recognize that you are getting this money. It doesn't matter when the money is going to drop in your account. So the second is the matching principle. Now this states that expenses should be matched with the revenues they help to generate. So you have these revenues, you have to match these expenses. Okay, did you pay transportation to go to this place to make this money? Did you do this in order to make this money? You're going to match those expenses to the revenue they got to help you generate. Number three, cost principle. Assets should be recorded at their original cost and not their current market value. Remember, you bought, let's say, a plant for 50,000 naira in 2014. And now you know definitely the cost of that plant is going to be way higher. So you are going to carry that cost as, you are going to carry the cost of that plant at 50,000 naira, the original cost. That is what the cost principle is all about. Number four, objectivity principle. Now this has to deal with financial information being based on objective evidence such as invoices and receipts. You are not just thinking, I bought this, I bought that. No, we want to see the papers. There's this very popular thing we get to talk about, explaining and no evidence. So we want to see the evidence. We want to see the papers. We want to see the receipts. We want to see the invoices. We want to see every document that has to deal with that very transaction. Now, number five is full disclosure principle. So all relevant financial information should be disclosed in the financial statement or notes. Everything that has to deal with that period should be disclosed. You should not hide anything. As an accountant, it is not legal to do so. So let's talk about the next thing, accounting concepts. What are accounting concepts? Accounting concepts are basic ideas and assumptions underlying the preparation and presentation of financial statements. Now, these are just the basic ideas and assumptions. You assume it should be like this. They provide the foundation for accounting practices. Now you're assuming, okay, it should be like this. We think it should be like this. And over time, people have been doing it like this. So that means it has come to stay. That is what the accounting concepts are all about. So let's talk about some examples of accounting concepts. Number one, going concern concept. Now this means that a business will continue to operate indefinitely. A business operates in perpetuity. So that means once a business starts, it's supposed to continue. You start a business today, you do not have to die with that business. That is why you hear banks, you hear businesses that have been in existence for 70 years. There's somewhere even going on for hundreds of years. Number two, the accrual concept. Now this states that transactions are recorded when they occur, not when cash is exchanged. Once the transactions occur, you are recording this and not when cash is exchanged. Number three, consistency concept. This is very necessary. The same accounting methods should be used from period to period to ensure comparability. You do not have to use a different accounting method in 2020. When it's 2021, you're using a different accounting method. No, you have to use the same accounting method so that you are able to compare. Did we make profits? Did we make losses? Okay, this is how it is. It helps you to easily compare these records. Number 4, materiality concept. So now, this means that only information that would influence the decision making of a user needs to be disclosed. And this actually differs from firm to firm, because what is material for my firm may not be material for your firm. Yes, that it depends on the amount of money, it depends on what comes into play. So know that only information that will influence the decision making of a user needs to be disclosed. That is what you should know. Number 5, business entity concept. A business is treated as a separate entity from its owners. I am Edis Brown, and my business may be Edis Brown and Sons. That means it is different from me. Whatever it is my business is owing you, I am not owing you. That is the truth, especially when it is incorporated. So you're dealing with the business as a separate entity, as a distinct person that can sue and be sued in its own name. The liabilities of the company are the liabilities of the company, way different from me. That is why when it comes to capital, it says you are lending money to your business. For instance, I started a business with 50,000 naira. That means my business is owing me 50,000 naira because we are two different people. Yes. So what is the next thing? Accounting conventions. Accounting conventions. Accounting conventions are common practices or guidelines followed to ensure financial statements are meaningful and comparable. So accounting conventions, these are common practices that or guidelines that have been set. They are being set and they are being followed to ensure that financial statements are meaningful and very comparable. So we have some of the conventions like conservatism. When in doubt, record expenses and liabilities immediately, but revenue only when it is assured. So only when they assure you of the revenue, or when you're certain of the fact that this revenue is coming in, that is when you should record them. Now, consistency. Use the same accounting method from period to period unless a change is justified. I had said that earlier. Full disclosure. Provide all necessary information so that stakeholders can make informed decisions. Do not hide anything from the stakeholders. Materiality. Only significant information that affects the decision of users should be reported. If something is not going to affect the decision of the user, remember that we said accounting is done for the purpose of making informed decisions. Yes, so you have to do this so that they shall use, or these people, these users of accounting information, will use the information you have provided, the interpretation, the information you have communicated, and make some decision. So let's talk about the significance of accounting principle. The first significance is that it helps in maintaining consistency. Accounting principles help businesses follow the same accounting principles over and over. Now, this facilitates advancing the usage and uniformity of all financial statements. So by this, the firm makes it easier for users of accounting information to evaluate the efficiency of financial information. Another thing is that it reduces the risk of fraud. Accounting principles help companies to reduce the risk of falsification of data and other fraudulent acts in businesses. Another thing we have to know is that it helps to plan ahead. Accounting principles provide an actual image of the business performance. You know that this is how the business is performing, and then it gets to help you to plan ahead because it reveals the accurate revenues and predicts the trends of cash flow in the business, which makes it easy for the business to keep record of its financial statement, which prevents it from skipping necessary information. So now we have the significance of accounting concepts now. What is the significance of accounting concepts? Why do we need accounting concepts? Now, the accepted rules and regulations guiding accounting have the following significance. I'm going to take number 1. It helps in achieving uniformity in accounting information and statements. It helps in achieving uniformity of accounting information and statements. Another thing is that it facilitates reliability of accounting information. It helps you to know that this accounting information is reliable. It also encourages a better understanding of the financial statements. It encourages a better understanding of the financial statement. It provides detailed and verified financial data about the assets and liabilities of an entity. This leads us to accounting information. When we say accounting information, what are we talking about? Accounting information refers to the collection of financial data and details related to the financial activities and transactions of an individual or organization. That is a lot of grammar. So basically what we are saying here is accounting information is any information, any piece of information, any data regarding the financial activities, the financial transactions of any business entity. That is basically what accounting information is all about. So it encompasses a range of elements that provide a comprehensive overview of an account's status and history. Now, the users of accounting information, who gets to use accounting information? Why do they use them? Why do they need them? Accounting information users are usually divided into internal and external, but at this level, I think I'm just going to box everything together. Accounting information is used by various stakeholders to make informed decisions. The list includes owners or investors. Now, why do owners or investors need accounting information? To assess the profitability and decide on investing or disinvesting. Now, the management is another user of accounting information. And why does the management need accounting information? To plan, control, and make strategic decisions for the business. Another user, creditors and lenders. Now, why do they need accounting information? To evaluate the creditworthiness and decide on lending money. So, people want to lend you money, they need your account to know whether you are creditworthy, whether they will be able to recover their money if they give it to you. So we have employees. Employees also use accounting information. But why do they need it? To understand the company's stability and profitability, affecting job security and salary negotiations. So as an employee, you're working in a company, you want to know what it is, where the company stands when it comes to the finances. You want to know whether they will be able to pay you your salary next month. That is why you need accounting information. Now, the government. Why does the government need accounting information? To ensure compliance with tax laws and regulations. The government wants to know that, yes, you are paying your taxes, you're complying with the tax laws, and you are complying with the tax regulations, you're complying with everything that you have to comply with. Now, the customers also need this accounting information. And why do they need it? To assess the financial health of suppliers. The customers want to assess your financial health. They want to know whether you're going to stay in the business, whether you're going to be out of the business. They want to know the people who are supplying to them, how they are financially. The last but one on this list is the general public. I know you're wondering and asking, why does the general public need to know about the financial or need accounting information? Now, the general public needs accounting information to gauge the company's contribution to the economy. They want to know how active you are in production. They want to know what percentage or how is it that you are contributing to the nation's economy. Now, let's get to the next heading, characteristic of accounting information. What should good accounting information possess? What characteristics? What qualities should they possess? So good accounting information should possess certain qualities to be useful for decision making. Number one is relevance. So the information should be applicable and helpful for making decisions. If it's not relevant, it is not supposed to be called accounting information. Now, it should be reliable. Reliability is the second thing. Information should be accurate and verifiable. Number three, comparability. So accounting information should be comparable with previous periods and that of other entities. Remember, we have spoken of consistency. So it should be comparable with those in past years, and you should be able to compare it with those of other companies or other entities. Number four is consistency. Information should be prepared consistently over time. I have mentioned that already. We have understandability. This is very important. You should not present accounting information that cannot be understood. That means nobody will be able to make decisions based on this very information you have provided. So it should be understandable. And the last thing we're going to consider right here on this topic is the role of accounting records and information. What role does accounting records and information play? It plays a very crucial role in the management and operation of business. So let's get to talk about some of these roles. Number one is a financial performance analysis. Financial performance analysis. It helps in assessing the profitability and financial health of the business. Number two, decision making. So it provides a basis for making informed business decisions. Accounting information or accounting records get to help you make decisions. You know that yes, you're investing here and you're going to make more money here, or if you invest here, you're going to lose this and all of that. So compliance is number three. It ensures adherence to laws, regulations, and standards. Yes, it ensures adherence to laws, regulations, and standards. We have budgeting and forecasting. That is the next one. So it assists in planning future activities and financial needs. It helps you to plan. It helps you to budget. It helps you to forecast. You're like, okay, if this is how much we made last year, based on these activities, this is how much we can make next year. You're forecasting based on accounting information and accounting data available. The last one here is stakeholder communication. So it provides transparent information to stakeholders. Remember, it helps them to make decisions. It helps them to know what to do in the business. So this is the end of this particular lesson. And I would like to say, like I said in the previous lesson, before you move to the next lesson, try your best to revise everything that has been taught here. The accounting concepts, the accounting principles, the accounting conventions, accounting information, uses of accounting information. Try to make sure you get to revise all of that. And if you have done that, or once you do that, you are ready for the next lesson.